The world of high-stakes casino development is a brutal one, where every decision is scrutinized and every move can make or break fortunes overnight. It's a landscape shaped by ambition, risk, and the relentless pursuit of profit, where only the boldest players dare to compete. Here, fortunes hinge not just on luck, but on politics, economics, and the ever-shifting whims of the elite. Deals are made in back rooms, alliances are forged and broken, and the stakes are always sky-high. For months, the race for 3 New York City casino licenses was the industry's hottest drama, drawing the attention of moguls, politicians, and Wall Street alike. MGM Resorts International, with its deep pockets and proven track record, was widely seen as a frontrunner. With its Empire City Casino in Yonkers, MGM seemed perfectly positioned to transform the property into a full-scale resort, promising jobs, tax revenue, and a new era of entertainment for the region. But in October 2025, MGM shocked everyone by abruptly withdrawing its bid. The news sent shockwaves through the industry, leaving competitors and observers stunned. The official reason? Shifting economic and competitive conditions. Corporate speak, for the numbers no longer worked. Behind the polished statements, the reality was clear. The financial risks had grown too great. Behind the scenes, MGM saw the odds worsen and decided not to play. The company's leadership weighed the risks and chose to fold rather than gamble with billions. This wasn't weakness, but a calculated move in a volatile market. In an industry where bravado often trumps caution, MGM's decision was a rare display of restraint and strategic thinking. The decision left rivals and analysts scrambling for answers, speculating about what MGM saw that others missed, and what it might mean for the future of casino development in New York. Building a world-class casino in New York demands billions in investment, years of planning, and nerves of steel. But as costs soared and regulatory hurdles mounted, the path to profit had narrowed dangerously, making even the boldest players think twice. MGM's retreat signaled a new era, discipline over ego, and caution over spectacle. It was a message to the industry. Sometimes the smartest move is knowing when to walk away. The post-pandemic world is unpredictable. Governments want more, competition is fierce, and economic headwinds are real. The rules of the game have changed, and only the most adaptable will survive. For MGM, walking away may prove to be a masterstroke of financial prudence, a bold bet on long-term stability over short-term glory, and a reminder that in the casino business, sometimes the best play is knowing when not to play at all. MGM's withdrawal wasn't just about fear, it was about math. The numbers simply didn't add up for a sustainable venture. 4 major casino proposals were clustered around New York, turning a fresh market into a battleground for the same customers. This intense competition meant that each casino would be fighting for a slice of the same pie, reducing potential profits for everyone involved. The dream of a regional monopoly vanished, replaced by the threat of market saturation. Instead of dominating the market, each casino faced the grim reality of diminishing returns. Worse, the license terms were rumored to be much shorter than expected, shrinking the window for profit. This meant that the time to recoup investments and generate profit was significantly limited. MGM faced pouring billions into a project with no guarantee of long-term returns. The financial risk was enormous, and the potential reward seemed increasingly uncertain. Construction, labor, and compliance costs in New York are sky-high. Add fierce competition and uncertain licensing, and profits look razor-thin. The financial burden was becoming too heavy to justify the investment. What once looked like a sure thing, now seemed like a money pit. The initial optimism was replaced by a stark reality check. MGM's leadership ran the numbers and couldn't make them work. The financial projections were bleak, and the risks far outweighed the potential rewards. The industry is shifting. Shareholders want discipline, not ego-driven mega-projects. Investors are now more focused on sustainable growth and prudent financial management. MGM's exit was a message. Growth, at any cost, is over. The era of reckless expansion is being replaced by a more cautious and calculated approach. In today's climate, prudence is survival. Companies must navigate the fine line between ambition and caution to ensure long-term success. As MGM retreated from the global stage, pulling back its ambitions and consolidating its empire in Las Vegas, a new player was ready to take a risk that could change the game entirely. Wynn Resorts doubled down, this time not in the familiar playgrounds of Vegas or Macau, but in the heart of the Middle East. the company is pouring a staggering $10.5 billion into Wynn Al Marjan Island, a sprawling luxury resort set on the pristine shores of the UAE's Ras Al Khaimah. This is one of the largest single investments in the region's hospitality sector. But this isn't just another hotel, it's a bold wager that the UAE will soon legalize casino gambling for the very first time, opening the door to a new era of entertainment in the Gulf. The resort will feature 1,500 rooms, each designed to offer guests a blend of opulence and comfort, with sweeping views of the Arabian Gulf. Guests can indulge in world-class luxury shopping, rejuvenate in lavish spas, and explore a curated selection of designer boutiques and wellness experiences. At the heart of it all will be a state-of-the-art gaming area, the first of its kind in the Gulf, promising to attract high rollers and curious travelers alike. Over the past decade, the UAE has worked tirelessly to diversify its economy, welcoming Western brands, international tourists, and new lifestyles to its cities. Wynn's CEO is betting that legal gaming is the next logical step in this evolution, positioning the company at the forefront of a potential gold rush. It's a bold move. While MGM consolidates and others hesitate, Wynn is pioneering into uncharted territory, hoping to set the standard for luxury gaming in the region. The company's ambition is clear: to secure a near monopoly in a wealthy, untapped market and become the face of high-end entertainment in the Middle East. If Wynn succeeds, it could redefine what entertainment means for the entire region, blending luxury, leisure, and gaming in a way never seen before. But the risks are enormous. No casino license is guaranteed, and the political climate could shift at any moment, putting billions on the line. Wynn's strategy is high risk, high reward, reminiscent of its boldest moves in Las Vegas and Macau, where fortune favored the brave. The question remains, will this dessert dream become a glittering reality, or fade away as just another costly mirage in the sands of ambition? Wynn's $10.5 billion gamble in the UAE is built on hope, the hope that casino gambling will be legalized. Ras Al Khaimah has set up a gaming regulator, but the final decision rests with the federal government. As of now, there's no official green light. Wynn is building a casino on speculation, trusting the law will change before opening in 2027. Without gaming, the resort is just another luxury hotel in a crowded market, hardly worth the investment. The financial risk is massive. Delays or legal setbacks could be catastrophic. The project's budget has already ballooned, adding pressure. Cultural sensitivities and regional stability add more uncertainty. Wynn is betting not just on law, but on the UAE's continued prosperity and openness. It's a high-stakes move that could pay off, or backfire spectacularly. Both MGM and Wynn face a persistent challenge: Macau. Once the world's gaming capital, Macau's fortunes have faded post-pandemic. VIP gamblers from China have dwindled, hit by Beijing's crackdowns and economic slowdown. Revenue forecasts have dropped, and both companies' stock prices have suffered. Wynn, with its focus on high rollers, is especially exposed. MGM's performance is also tied to Macau's struggles. Despite strong Las Vegas results, the Macau malaise is a stark reminder: over-reliance on one market is dangerous. MGM and Wynn now represent two radically different strategies. MGM's New York exit is about risk aversion and capital discipline, focusing on proven markets and steady returns. By avoiding costly battles, MGM frees up resources for its core strengths. Its cautious approach, in the UAE, opening a non-gaming hotel, shows patience. Wynn, meanwhile, is all in on bold expansion. Its $10.5 billion UAE project is a bet on creating a new market and securing a monopoly. If it works, the rewards could be massive, but the risks are equally huge. No guarantee of legal gaming and a massive financial commitment. Wynn could become the industry's boldest innovator, or a cautionary tale. The future of casino gaming may hinge on which strategy wins. The paths of MGM and Wynn are set to diverge even further. MGM will likely focus on consolidating its Las Vegas stronghold and maximizing steady growth. Its success depends on discipline and avoiding risky expansions. If rivals strike gold in new markets, MGM's caution could look like missed opportunity. For Wynn, everything rides on the UAE. If gambling is legalized and the resort thrives, Wynn's gamble will pay off spectacularly. If not, the company faces a financial disaster. The stakes couldn't be higher. Success means dominance. Failure means crisis. The next few years will reveal which strategy prevails. The dice are cast. The future of two casino giants hangs in the balance.